Hi everyone, welcome back to Beat It. It's me Vinod here recording from Bangalore, and today I have something interesting to talk about. Thanks for all the feedback yesterday. I really did enjoy going through them. Vishnu Vardarajan, thanks for the feedback on the content. We are trying to do something different here. I know we're used to talking about Indian stocks on this channel, but since Anand is talking a lot of it in Money Page, I thought we would try and do something different here. This is from Anand only, where we try and focus about non-Indian stocks and non-Indian news which are of interest to a lot of people. So we try and do that here. And Prakash said Netflix is the biggest pile of dash movies and series. Netflix not worth getting a subscription. How can it share have any worth? Well, uh, Russia 88. I would say as an investor, you should keep in mind you may have a strong opinion about a company's service or a product, but if they do dominate the market and they do have a presence as an investor, you should have an even keel in your mind and not be strongly opinionated. If you see value there and you can understand the value, then you should worthwhile investigating. I'm not saying you should buy Netflix or that you should go against any principles or any uh, ideology or dogma you may have. But as a value investor, it's always worth exploring to see what is there and try and understand why it's happening. If not in the case of Netflix, you can definitely use that lesson you learn somewhere else down the road. Netaji Murli, yeah, if they put Ajit's thing in the thumbnail. Yeah, sorry, man. If you do enjoy it, I'm happy. If you didn't, sorry. If you're an Ajit fan, I didn't mean to offend. Gangster officials, tell about Bank of America. Then Saeed is asking about Qualcomm and TSMC and Applied Materials. Are they in consideration? Green, should we put them in our patas list? Well, I'll do those companies on another day because I've come prepared to talk about something interesting. And Balaji is asking, what is the limit of Tiffin Coffee range for US stocks? So they apply for US stocks. Okay, you want to know what Tiffin Coffee range is? Well, that is why we call it Tiffin Coffee range. Tiffin Coffee is the range, it's not currency dependent, it's not market dependent, it is you dependent. It is the amount of money you are willing to forego or lose in the market if things turn bad. And things can turn bad, as we've seen in the last few months since the beginning of the year. Things have been going sideways sometimes, and sometimes we have seen some recovery as U-turns are being taken on policy, on views. You see the U-turn in the market and price recovery happening, and we've seen that in Wall Street recently, where there's been a sudden recovery thanks to Trump taking a U-turn. When you see these kinds of recovery, something that happens always to value investors is something known as value trap. Okay, value trap is when a stock looks on the surface, purely on the metrics, it looks like it's very good, and we feel like buying it because purely looking at the numbers without deep diving into the story. And when you deep dive into the story, lo and behold, you find a lot of problems. And one of the companies which I want to give a great example is about a company and a brand which is one of my favorite brands, and I have many of their products since my childhood. And it's a luxury brand, and it's a Swiss brand. Company which I'm talking about is Swatch, of course, and the Swatch Group, which is traded in the US under over-the-counter method, right? It's a ADR, which is sold over the counter. It is a OTCQX, which is the best quality of the OTC. What's an OTC? It's an over the counter, and that means that this stock is not regulated. It has lower liquidity, and there's no centralized exchange where it's sitting on. But it is out of the three versions of OTC which can be there, which is the OTCQ, which is the best quality wise swatches. You have the OTCQB, where there's a venture stage companies, and then you have the pink sheets, which are very, very risky. So Swatch is traded in this method in the US. If you're looking at Swatch as a company, how to buy it in the US. So why am I saying it is a value trap? Because on paper it looks like it's undervalued, but then we will see why the classic signs of a value trap are there. Recently, the shares of Swatch has fallen by 24% since 2014. It's been underperformed as a share against all its peers. Of course, if you're talking about LVMH and all of the others, Swatch is underperforming. Net profits have fallen by 75% year on year, and that is at 219 million. The premium brands which they have is Omega, and that is down to 1.8 billion Swiss francs. They have the Longines, which is down to 1.2 billion Swiss francs. At the same time, which we're looking at where Swatch is main premium brands sales have fallen. Cartier and the rest of them have seen pretty significant growth. But this is what I'm saying is not the trap. You'll immediately look at this and say, yes, we know, then you should not be even talking about Swatch. But here's where we start getting into the trap portion, where you finally look at the numbers and you see maybe you should be looking at it. Because Swatch has maintained a net cash position, which is very rare in this sector, because usually luxury brands have don't maintain this kind of net cash position. But its free cash flow has been shrinking. Why is it shrinking? Because the sales are stagnating or declining. And we also have another issue, which is very limited transparency in their communication. They don't have much investor communications, very minimal. And though the communication, whatever comes out, it comes in Swiss German, which as an English-based investors like you and me, we can find it very hard to understand what they're saying, what the numbers mean, if we can't understand the language. So what would you say then would be the red flags if this is a situation? The major red flag for a value investor in this case in Swatch is the leadership. The leadership is now run by the son of the founder, Nick Hayek. The problem is he has a stance which is anti-investors, and that is what is fundamentally felt by fund managers and analysts, that he's not very conducive to welcoming new investors or the existing investors of Swatch. He seems to be a maverick and doesn't really have a demeanor towards investors. He doesn't come on calls, he doesn't come on number calls, he doesn't talk to analysts. So this is an issue. So if this is the issue, then what's the problem? If he's only a leader, investors are of course important. It could be your argument. But the family controls 25% of the equity, and of that, 44% of the voting rights are held by the family. So that really puts investors in the back foot if you're looking at Swatch. They do spend a lot of money on R&D, which is good, but that kind of spend what they've done so far has not significantly given strong returns. That means whatever collaborations they're looking at doing and ideas they've spun out using Swatch and Swatch sub brands hasn't really yielded the kind of returns a spend has given meant. So there's been a lost in brand prestige. It was once considered an elite brand, no more. Omega and Longines. I would like to hear your opinion. What do you think about the Omega brand and the Longines brand? If you're a watch connoisseur, do you think those brands have lost ground to the competition? There's been a strong resistance from Swatch itself in the retail model. They still believe in the brick and mortar model. While the world has slowly moved towards the digital economy, Swatch doesn't want to embrace digital economies. They're refusing to go digital, and even in the e-commerce route, Swatch is not very keen on. And of course, I've already told about the way they are alienating investors. This all said, most value investors, we immediately look at the numbers of a company to see if it is of value. And this is why you might suddenly just look at the numbers and see it's a big brand, old brand, a Swiss company, and just start ticking all the boxes and think of buying Swatch because the market capitalization is at $12 billion. What is listed in the US? The PE ratio is at 15x, which is far lower than its peers. Dividend yield is at 3%, which is pretty good. And price to book is at 1.1x. So it shows that there is value here. So the pros immediately will, like I said, will scream at you is they have a strong brand legacy, legacy brands, Swatch, Omega, Longines. They have a net cash on their balance sheet, right, which can give some kind of protection for investors and the company. It is trading at a deep discount compared to its peers, and the recent news about some activist investors getting on board can do a potential turnaround. There's been lots of news been floating around. There's been on an article that came in Financial Times also about this, how an activist investor is trying to reshape the company and negotiate with the family and see if they can unlock value. But same reasons what you think are the pros become the cons themselves. There's a deep family control. There's a lack of communication, and there's persistence underperforming and declining market presence and market share loss has been something which is where the problem lies. So, is this a value trap? I think it's a value trap. Swatch. It may be at a great position in terms of value, but a lot of people are arguing since the activist investors have come, it could prove to be a catalyst and it should definitely be on your watch list. Would you put Swatch on your watch list, considering all the other luxury brands which are there, which are performing so well? Some of them have become some of the most valued companies in the world now. Do you think Swatch may have such a turnaround and run go for a run, like how we were speaking about Netflix? Will it be a success story like Carl Icahn did in Apple from 2013 to 2016, or Netflix what he did in 2012? But do remember, there have been activist investors who have failed, like Nelson Peltz in Procter and Gamble, and the Starboard value famously with Yahoo between 2014 to 2016, where the board of Yahoo did not take any of the recommendations, and finally it was sold at a very deep discount to Verizon. So, what do you think are the value traps in the American market or Indian market? I would love to hear your thoughts on this. Or do you disagree with whatever I said and you think Swatch is a long play as a time value investor? This is something you're willing to take a bet on and risk some cash, considering the deep discount the stock is trading at. Would love to hear your thoughts and views. Do share them, and I will definitely read and give you my opinions and feedback on the next video. Thanks for watching the video today. I hope you found it informative and entertaining as always. I am heading to Singapore and I'm trying to meet some of you there when I'm in Singapore. I hope you also are free during the weekend and we can catch up for a cup of coffee and have a conversation face to face. I would love to meet all of you there. That said, I am meeting some of you in Bangalore on 31st, and those of you who managed to fill out the forms, I'll definitely send you a reply and we will send you the venue location and we'll catch up in Bangalore. Well, nothing else more to say. I hope you had a wonderful day and a wonderful evening and you're recovering well from the rain trauma which all of us are going through in Bangalore and in Chennai and in Hyderabad and southern states. Thank you for watching Be Rich Tonight. Good night.